Welcome back to another episode of Gimme Some Truth. It's an interesting topic today, potentially shifting of some decades-long run that we've been on in the market. We're not predicting that, but we're going to talk about it. Is value finally finding the spotlight again after roughly 15 years of growth hogging it?
And I think the catalyst for value coming into favor potentially would be something that someone wouldn't necessarily expect. Did AI actually lead to value becoming in favor again? Or
said another way, did AI kind of crush the growth trade?
Yes.
Maybe, right? And I think we're going to talk about some of those things today. And again, it's not our goal today to try to predict where this is going to go, because this feels very much like the kind of the advent of the internet. Clint and I were both well alive and well aware when that happened, and when email became a thing and Hotmail accounts. And what's the first email server that do you remember? I think for me it was No. What was the one before that?
AOL, right?
AOL. Yeah, you're right. That I still can hear that ding or whatever that thing was that was in the marketing back then.
You've got mail.
Yeah. This feels like it has that level of kind of size and substance to it. And I think a lot of what you're reading right now is telling you that not only is AI not a fad, not only is it here, not only is it making changes, it's literally making drastic changes by the days and weeks and months, not by the years.
Well, every week it seems like AI wrecks some other sector or industry because a report comes out or a story comes out of a company doing something that is novel. And a good example in our industry is that there's something called Hazel AI, and Hazel AI was just an offshoot of another upstart custodian. Altruist comes out, and they come out with this software, Hazel AI, and all of a sudden it's supposed to help with tax planning, and you can upload a whole bunch of tax stuff and it'll spit out all this great tax stuff for you. And by the way, it's a note taker. And by the way, they're developing a CRM around it. And all of a sudden, overnight, it seemed to kind of like break the fintech world, saying, well, if some AI upstart can do this, and we know this is the worst that this software is ever going to be, and it's already pretty good, consider, version 2.0 and 3.0 and 4.0, and will it actually completely change the way that all these fintech startups and stocks are valued? Because what we're valuing here is discounted future cash flows, right? So now these cash flows become very uncertain in the future. And once they become uncertain, then the valuation must change. And so you see that negatively react when you see this news come out and these novel things come out. And all of a sudden, what is this software worth in the future? Because in the growth trade, what you're paying for is future growth. A value trade, a value-oriented company, you're usually getting a dividend, you're getting steady, stable growth. And the growth is saying, well, in the future, we're going to be much bigger than we are today. And so when we look at that, our revenue is going to continue to grow. And now when we put a question mark in front of that, now the value changes.
Well, and not to mention, depending on where you want to draw the lines, right? I mean, you've had literally a 15-year period of growth being dominant to the extent where today, we just looked at this before before Courtney hit the record button. 8 of the top companies in the S&P 500, the top 8 companies are all tech companies, right? That doesn't mean they're all growth companies. You could argue that Microsoft is a value company now and things like that, but still a tech company at heart. And so the idea of just buy the S&P 500, bury your head in the sand, and come back 20 years later, I'm not sure that that's the most prudent trade right now, because of how top heavy the S&P has gotten, because it is what's referred to as a market cap weighted index. The biggest companies rise to the top. So if you have the top 8 companies that are all tech companies, you have concentration risk that is abundantly apparent, but yet at the same time very well much not known by a lot of the people that own the S&P 500. They think they bought a diversified index.
Well, and they've kind of rigged the sectors now too, because what they did was they took out some of these companies and put them into different sectors, when at heart they're really technology companies.
Right.
Tesla's a good example of this. Is in the automotive sector. I think it's tech. It's a strong tech company.
It's a tech company that uses cars to basically provide its technology.
Yes,
is really what it is. The car is just the shell, if you will, of their technology.
Yeah, and Microsoft is extremely diversified. And Amazon, are they a technology company or are they a shipping and logistics company? And they are both, you know. So, but they at the heart of everything they do is technology.
Well, what is Alphabet?
Right.
I mean, what doesn't Google do? You know what I mean? You start to see these iterations, and you're like, what are these companies? What is Meta even?
I don't know yet. I don't know if I want to even comment about what Meta does, because they're really bad at AI right now, but they might end up, they're putting in a ton of money into everything. They pay their people just incredibly well. Obviously, they're a social media company at heart, but they've gotten into the metaverse. They've gotten into wearables. They've gotten into all sorts of different things. And now they're going to be building data centers, as in a lot of these other tech companies are strongly investing in these data centers. And it's a CapEx that they're not used to. Yeah. So as a result of that, you know, if you kind of look and zoom out on this, and this is where I think it gets really important and really exciting when we look at investing going forward. If you zoom out, what are the companies that are going to benefit from this trade? Well, if we have 3 to 5 years of an extreme build out in data centers and energy creation, where do those companies land? And oftentimes they're traditional value sectors. So you have a lot of construction companies that are going to be just rocking and rolling. You need a lot of energy. So you have energy companies and utilities. Infrastructure. All of those sorts of companies are going to more than likely be very much in favor during this period of time. And then your knowledge worker economy is a bit at risk as well, with all of these kind of software as a service companies that have been just rocking and rolling and growing like weeds. And now AI kind of makes everything go on pause there because there's a lot of uncertainty.
Yeah, it's an interesting time, and it's weird to think that you know, a potentially historic technology breakthrough could be what ushers in, you know, a value trade. But I think the Fed is going to find itself in a really difficult position over the next 12 to 24 months as jobs continue to get cut because of the developments within AI. And then what does that mean then for the employment market? And what does that then mean for just the economy in general, right? Because it's going to make companies more efficient. It's going to then likely produce more profit on their balance sheet if they're able to reduce overhead. So you have potential, you know, expansion, if you will, of profits and kind of leeway, if you will, within those companies. But you will also have exploding, possibly, unemployment.
Exactly.
And white collar unemployment, which are, if I lose my job here, I can't just go over to this other company because that other company probably adopted AI too. So where do I go then to find my next job?
That's right. There's a huge risk here. And so, you know, there is this sort of, this time it's different sort of thought out there. And I do think that we're going to have a transition in our workforce. And I think it will be net positive. I always look at things rather optimistically, but there could be some short or intermediate term job runoff that could be significant, particularly in white collar areas as well. And one thing too is that what used to take maybe 5 years and a whole slew of software engineers now might take 18 months with a skeleton crew, because we're using AGI now, or agentic AI now, with all of these agents doing the work of a lot of different coders or people all at once. And that sort of team that's able to stand up, that never gets tired, that runs 24/7 and all of that is going to be very efficient, and it's going to lead to some enormous opportunities for growth for companies, but also creative destruction as well of a lot of these SaaS companies that used to stand up technology and do all these things might no longer exist 12 or 18 months from now because of agentic AI and the freight train that it really is.
Yeah, so if you think about kind of what does it mean then moving forward, right? And again, I sound like a broken record, but we're careful not to predict when it's going to happen because nobody knows, and we could still be within the growth trade 3 years from now. I mean, there's absolutely a case that could be made for that. But there are signs right now that indicate that we're potentially seeing a slowdown within that growth trade. It's becoming more choppy. It's becoming more volatile, right? And so it's not just this kind of normal not normal, but kind of consistent, if you will, track up and within the charting of it. It's become much more good days and bad days, where before it was 4 good days for every 1 bad day. And so there's definitely tangible evidence that this is slowing, and potentially could find ourselves almost in a spot of uncertainty, because it's been going for so long. I don't know that people really understand the feel of opportunity within value. That just it almost seems like that's not even a statement that it seems like that's an antiquated statement. That's a statement from the 80s and 90s.
That's right.
That's not today. And you're like, well, at some point it's going to be today again.
Yeah, when we look at valuations, I mean, value is very attractively priced relative to growth.
Sure.
Growth is expensive. You are paying a lot for earnings right now.
Yeah.
And now that earnings are a bit more uncertain, or I would say revenues are a bit more uncertain as well, perhaps value is the new growth. And also large caps and mega caps have been very much in favor for a long time. And perhaps it's time to relook at small and mid caps and their valuations relative to these mega cap growths as well. And like we indicated, upstart companies with small staff can have a massive impact, and they can blow up to mid-size and large companies faster than they ever can in the past.
I think you're exactly right, and I think that while it's difficult to see where it'll go, it has feelings of kind of the tech bubble. Not just in terms of the valuations got so high and got so pressed that it become almost impossible for them to continue to push further, and so that balloon had to kind of pop at some point. And the whole concept of bubble is kind of weird just in and of itself, because it kind of almost become a buzzword lately. But I think I would refer to it more as a tiring, if you will, of an industry or of a trade, and it feels like it's starting to tucker out a little bit. It just feels like it's losing some momentum, and I don't know that you can just rekindle that momentum after it's been on the run that it's been on. And it's not only domestically. This is absolutely a global argument. This is not bound simply to New York to LA. This is global that this is the case for sure, and potentially even has a bigger impact in foreign stocks than it does domestic.
Mm-hmm. Yeah, I think long term, I think you look at what it's going to mean for corporate profits. I think largely it will be profitable and good for companies, but at the expense of probably reducing some headcount.
Yeah.
So you look at why we buy stocks. It's future cash flows, it's future revenues, it's all of that. Well, if the expense line comes down, because I believe in general, short term AI might be inflationary because you put all these costs in for energy and things like that are going to be in there. But long term, I think it's deflationary. I think it ends up bringing prices and headcount and everything down. So your expense bends down and your revenue, even if it stays the same, well, obviously that company is more valuable now because you're able to bend that cost curve down. So, with all of that, or how many software seats you need in your organization. I know we as an organization are looking closer at our spend on our software because, will all-in-one tools do a better job? Will, is this software necessary now? If we can run a quick query and run a quick portfolio stress test, do we need all of this expensive software to look at all of these things? Can Claude end up doing, a lot of tax analysis or financial planning work as plugins rather than having this expensive software? So all of that is going to exist as conversations in the next few years for sure.
Yeah, and I think all you have to do is look back at the top 10 companies in the S&P 10 years ago, 15 years ago, 20 years ago. It was a kind of well-diversified suite, if you will, of companies. Not the case anymore, and you've seen that push. And so inadvertently, whether people realize it or not, their portfolios probably become significantly more tech-heavy, more growth heavy. And even if somebody started with the plan of saying, I want to be as balanced as possible, and they did that 10 years ago and they haven't made any trades, you are no longer balanced. That is not a thing anymore. You have become that whether you thought that you wanted to or not. And so we strongly encourage people to say, really understand where your money is positioned right now, because I think the stat that I saw was in the last 4 years, 60% of the S&P 500's rate of return has come from those top companies. You are now a value company, or a growth portfolio if you have the majority of your money in what you thought was a well-balanced, index.
That's a tremendously good point. And I think going forward, and this is just my PSA, is if you sat in index funds and what we just call beta investments, if you own the S&P 500, you got a really traditional portfolio going forward, that served you super well the last 10, 15 years. That was great. But I think that door is now shutting, and you really need to look at your portfolio, and you have to look at where your allocation lies and how to constitute your portfolio in a better manner than just beta now. And you can use it with index products, but you have to shift it yourself. You can't just go, oh, I'm just going to live with the S&P 500 and the ebbs and flows of it and wait for those value companies to become higher in the index. I think if you do that, you're going to end up doing yourself a disservice. So I really think now is the time to dig more into your own portfolios, and to, have professionals look at it, have professionals constituted for kind of the new world. And I think that we've done a job in some of our portfolios to tilt it and may even go further.
Yeah, I think it makes me think back to 08, 09, when you and I were doing this, and a lot of the ugliness from people's portfolios and where it left them from a net worth standpoint, where they were to, where they were, 12 months later, 18 months later, and this feeling that like this happened to me and there was nothing I could do about it. Well, there's a chance that what happened was you rode, 2003, 4, 5, 6, 7, and got more aggressive in your portfolio without making one trade. You got more aggressive because stocks outgrew bonds. And so therefore that impending fall made you lose more than you probably thought you should because your portfolio inadvertently got more aggressive.
Exactly right. Yeah. And same thing in 01, 02, when the indexes got, so tilted in that, 1996 to 1999 trade, all of a sudden tech overwhelmed everything. And it was all different, and all this money piled into this, and you were paying way too much for earnings. And yes, it's not that rich right now, but it's not that far away either. But if you had tilted your portfolio into growth, yes, you would have given up some of that in that 96 to 99, but you would have held up much better in that subsequent tech bust. So,
yeah, I mean, if you maybe not, right? 2023, 2024, 2025. Right? We'll see. I mean, some big years in there, all led by tech. We'll see if that doesn't kind of peak in where that goes. I think that you and I have failed to give the viewers and the listeners the slice of life stuff that we have we've been known by. So I'm going to give you one as we end this podcast. I want your top 3 pastas. Noodles.
So we should get into your long noodle thing in a moment, but
that'll be evident in my answer.
Yeah, exactly, because they're all going to be small. But I would say number 1 for me is fettuccine. Number 2 is rigatoni.
Okay, sure.
Number 3 would be linguine. So those are my top 3.
Wow.
With a special mention for a bow tie. I don't mind occasionally, particularly in a cold pasta salad. I think bow ties and spirals are superior for any sort of cold pastas, whereas I don't favor them for a warm pasta dish. So those are my favorites though. Now you have an strong aversion to long noodles.
Don't like long noodles. Never have. Not a fan. So my top 3 are penne, which is just the GOAT. But bow ties are a very close second. And then a very unknown, because it's a little bit of cheating, but risotto.
Okay.
Which is technically a pasta. And it's fantastic.
That's kind of cheating. All vegetables are technically fruits, kind of when you look into it. I get that. Okay, that's fair. Yeah. Also, how would you rate? Do you do better when the pasta is baked? Are you a baked ziti guy?
Well, yes and no. I'm a huge fan of lasagna, even though that does technically have longer noodles. Okay, but who doesn't like lasagna? I mean, that's crazy. Yeah, the bakes are fine. I tend to find that it's hard to get that right because you get some of the pasta that gets kind of crunchy and then some of it's kind of not. And I don't know, the whole bakes just that with pasta just doesn't seem like the right idea.
And I'm not Italian, so I kind of feel a little bad about that. I feel like I need to go someplace to get an actual baked
Yes.
Like a restaurant that's Italian that can really do it right.
For sure. I said to my wife last night, if they made risotto a side dish, man, imagine that. Like if you could order risotto as a side dish to your main entree, it'd be fantastic.
It's very filling. It's very good too. Very rich. Yeah. It's fun, but a pain to cook too.
Oh, absolutely. Yeah. It takes what you and I don't have, and that's called patience. I think that's where we'll wrap it up today. I obviously we had a little fun at the end, but I think that there is the seriousness of it is that we have seen easy times in the market, quote, easy times, and then we've seen difficult times. And it feels like we're ending a period of easy and going into a period of difficult. And what's always served us well in those times is the idea of true diversification, and not just diversified, but diversified with a rebalance strategy that makes sense, and making sure that portfolios don't creep and go into areas that we didn't necessarily intend for them to go. And so this is absolutely one of those times. If you don't fully understand what you own, if you don't fully understand how your portfolio is constructed, if you don't fully understand your risk profile right now, as we like to say, if you're going to make changes, make changes when it's sunny outside, not when the thunderstorms are over the top of the house. So we encourage you to strongly look at your portfolio and just at a minimum understand where you're at and what's under the hood. So thanks so much for tuning in to another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.